Hello everyone, welcome to this video. This is Harsh Baldava and today we are going to be discussing about mergers and acquisitions modeling in Excel. So let's get started. Coming to the very basics, what is a merger? A merger is when one entity completely absorbs another entity either through an all cash deal or a stock for stock deal, or it takes loan and then purchases the another entity. So it completely absorbs the other entity in itself. And in case of an acquisition, one entity purchases a part of the another entity. It does not completely absorb it, it just purchases a part of it. So in this particular example, we are going to discuss about a merger. Okay, so here we have two companies, the buyer company and the seller company. Okay, the seller company is also known as the target company, and these are their equity values as on date, and this is going to be a stock, an all stock deal. Okay, so the buyer company will be issuing its stocks to the seller company in order to purchase it. So first, coming to calculating the swap ratio, how do we do that? The share price of the buyer company is 29 and the seller company is 37.2. So to calculate the swap ratio, you need to simply divide the seller equity share divided by the buyer equity share, which comes to 1.28. So in short, the buyer issues 1.28 shares for every one share of the seller. Okay, so buyer gives 128 shares for every 100 shares of seller. Now the total number of equity shares is 85. So the total number of shares that the buyer has to issue to the seller, as it is giving 1.28 shares for every one share, it will be 1.28 into 85, this which is in millions, will give the total of 109 million shares. So the buyer will issue a total number of shares which is equal to 109 million for purchasing the seller. Okay, so now coming to the calculation of enterprise value, the formula for calculating the enterprise value is market value plus equity plus the market value of debt minus the cash. Why are we subtracting the cash while calculating enterprise value? Because let's say a company buys another company, so the cash of the target company is also yours, right? So effectively it's reducing your cost, so that's why you will be subtracting the cash. So when we are calculating the enterprise value for the seller company or the target company, we'll take the consideration paid by the buyer, which is 3159.1. This is an all stock deal, just as a reminder, and we'll be adding the debt and then we'll be subtracting the cash. Okay, and the enterprise value comes to 3411.9, and the latest EBITDA of the seller is 484, and so we calculate the EV by EBITDA ratio by simply by enterprise value divided by the EBITDA, and that comes to around 7. Okay, so this is the purchase price calculation. Now we'll come to the calculation of the goodwill part. So usually in the real world transactions, the target company is always, always expects a premium from the buyer company, because let's say if you don't offer any premium relative to the current market value of the target company doesn't have an incentive to evaluate your offer as such. So will have to calculate the goodwill in this case, which is nothing but the excess consideration given over and above the fair value of the assets of the target company. So the way we calculate this is, whatever is the purchase price, the purchase price is 3159.1. We'll subtract the seller book value of equity, the target value of equity, and then the sum of these both is nothing but 2553. Then we'll also subtract the gross block written up. I'll explain what this is in a while, and we'll add the deferred tax liability. Okay, so the total goodwill created over here is 2500.6. Now why are we subtracting the gross block written up? So when we are acquiring the target company, there is a revaluation exercise done where the fixed assets are revalued based on their current market prices. So when a revaluation happens and the current market when a revaluation happens to the current market prices, there is a revaluation gain, right? So that is a gain for the buyer company, right? So you need to subtract it from the overall cost. Okay, and that will create a deferred tax liability as well, because this revaluation gain may not be considered as a gain from the point of view of the tax authorities. It may just increase your accounting profit, but it may not be considered as a taxable profit. So that will create a new deferred tax liability, as your tax base has increased, but it has not increased from the viewpoint of the tax authorities. Okay, so the new deferred tax liability will have to be added, and then the final goodwill comes to 2500.6, which will be a part of your assets of the combined entity. Okay, so yeah, so if you see over here, the gross block is 888.9, and we are assuming that it will increase by, let's say, 10%. So the gross block is written up by 88.9 in that case, and then you'll be charging some depreciation as well on the addition added gross block, which will be, let's say, we are using a straight line method, so the depreciable life is 10 years, so it will be 8.9 per year. So 88.9 minus 8.9, so the final addition will be 80, right? So this is what you will be subtracting from your equity purchase price to arrive at your final goodwill figure. So coming to the balance sheet, first let's talk about the fixed assets. So the way we get to the fixed assets on the combined balance sheet is simply adding the buyer's fixed assets plus the seller's fixed assets plus the revaluation amount of the fixed assets. Similarly goes for depreciation as well. The buyer's depreciation plus the seller's depreciation and the depreciation on the revaluated fixed assets, which gives you the total depreciation of the combined entity. Then over here we can see we have added the goodwill, which we arrived at on this tab. 2500.6 is added, and which is a part of the asset of the combined balance sheet. Okay, so there are some nuances which we need to take care of. For example, if the deal was an all cash deal, you would have subtracted the cash, because the buyer entity has paid cash to acquire the seller entity, right? So the cash will get impacted and it will be subtracted from the final balance sheet. Okay, and similarly loan funds. So let's say if the buyer entity had taken a loan to acquire the seller entity, your liability would have increased by the loan amount, and the deferred tax liability has been increased by 27.7 as shown over here on account of the revaluated fixed assets. Okay, so coming next to the equity. So if you see over here, 2309.1 plus 850, the total comes to 3159.1, and which is what will be adding to the share capital of the buyer entity to arrive at the final share capital of the combined entity. And the reserves and surplus, so the seller's reserves and surplus will be completely written down to 0, and the reserves and surplus of the buyer will be carried forward as it is to the new combined entity. So just to clarify over here, the way we have got this figure is by simply, subtracting 850 from the purchase price 3159.1. Okay, and that's how you arrive at 4629.1. Now let's go to the P&L statement. Now coming to the profit and loss statement, as you can see, the net sales are ideally the sum of the sales of the buyer entity and of the seller entity. However, you can see I have made an adjustment over here, that I have increased the sales of the target company by a variable of 8, and there's a drop down created over here. So I can explain the logic behind this. So all these are estimates, okay, for the next 2 years. So if you're acquiring another company, you believe that there will be some sort of synergy created, okay, and the combined sales will of the new entity will be more than the summation of the individual sales of both the entities. So that's your motivation of buying another entity, right? There has to be some sort of synergy created, otherwise why would you go ahead and pay a premium? Similarly, for cost of goods sold, the cost of goods sold, if combined of both the entities, it also increased by 8%. So then there is no use of buying another entity, right? So I've assumed that the cost of goods sold only increased by 5% overall. So there is some rationale behind buying this new company. So while deciding which company to buy, all this exercise is carried out where estimations are made as to how much the sales will be increased and how much the cost of goods sold will be increased and what synergy will be actually created. So if you see, the formula is simply the sum of these both, where I've increased this figure by a total of 5%. Okay, so this is how you create your combined P&L statement. And when, if you want to calculate the EPS of the combined entity, what you do is you take the number of shares outstanding of the buyer, which was 147 million. Then you take the number of shares issued, which we had calculated over here. 109 million additional shares were issued by the buyer company to purchase the seller company, which takes the total to 256 million shares. And the 256 million shares, so then you, for to calculate the EPS, you simply have to divide the final profit after tax by this 256 million, which comes to 0.55. Okay, so this was a brief explanation as to how you model a merger. And if you like this video, please do like and subscribe, and see you in the next one. Thank you.